Well, welcome everyone. We are going to get started in just a moment, give people a chance to get in here. Um, but thanks for joining today, and we'll get started in just a moment. Thanks. All right, well, we're going to go ahead and get started. Thanks everyone for joining us today on our webinar about Impact Dashboard. And specifically, we're going to be focusing on or talking about how to model and evaluate some of the common economic development incentives. And so a lot of the attendees, I think, are on from Texas. And so we'll be kind of focusing a little bit more on the kind of the typical Texas economic development incentives. But if you have questions, feel free either in the chat or the question and answer to type anything in, or if there's something specific you want me to talk about, go ahead and type that in. I'll keep an eye on it. But I'm going to start out with a little bit of an overview of just kind of what Impact's Dashboard is all about, and then we'll kind of get into some of the more specifics. Before we go any further, though, my name is Paul Shurin. I'm an economist and principal with Impact Data Source. Impact Data Source is the company behind Impact Dashboard, and we do all of the support and training and kind of the research and updating of the data in the background. So for our clients, they're going to be collecting information about a prospective project. So the number of jobs, the salaries, the capital investment, they're putting that in there, and we're taking care of a lot of the information on the back end, tax rates and economic data and so forth. And so I'm kind of a point person there for working on those. And we also do individual studies, of course, if you just need a one-off report, but we also have this subscription, which a lot of our clients really enjoy having the access to kind of on an as needed basis, kind of whenever they want to log in. So we're going to jump right in. We can see my screen here. I've got our project Vandelay Industries pulled up. We're on or inside kind of our scenario workspace. So we can see our navigation here. We've got a scenario info tab, which is where we're located. This is where we can put in all of our project specific information. We can see we've got some of that visible here already, the jobs. We've got 95 jobs phased in over 2 years, for example. We can see a summary of our results. Since we've already kind of typed in some of this stuff, we can see our results are calculating. Up across the top, we've got a couple other screens. We've got a public support tab. This is where we're going to configure those incentives, and we'll talk about that a good bit today, but I won't stop on it for right now. And then ultimately where we're going with all of this will be these various reports that we can generate. And so I'm going to start in terms of talking about and presenting Impact Dashboard. I'm going to start on this fact sheet page and kind of go through the reports and just kind of help you get a sense of where we're going with all of this analysis and really what Impact Dashboard is all about. So as we're here on the reports page, the very first report that we see that in our kind of list up here in the upper left-hand corner, we have a fact sheet. And the fact sheet report is really just kind of, you can think of it as a cover page describing what's going on with this project. So we want to summarize all of the basic information that we have about the project. And then we can also include descriptions or other kind of text details about the project. So this is just a nice, as I say, kind of cover page where we can repeat back the basic facts of the project. So if we look at this one for Vandelay Industries, starting kind of in the upper right-hand corner, we've got that this is a recruitment project in our advanced manufacturing industry. They're considering this particular site. We can see the company information is listed there as well. We can see that we've got the company name as confidential right now. If you wanted to, you could enable that and kind of show the name of the company. We've added some company notes, just kind of giving some additional background on who the company is here. On the left side, we're talking about, or we're describing the other details about the project. So here we've listed out the NAICS code, where we've identified the amount of square footage that they're looking for. They're planning to construct a new building after purchasing some land, so we see that. We also see their timeline in terms of breaking ground and beginning their operations. The kind of the key metrics there around employment and salaries and capital investment are there in those big blue boxes. We can see it's going to be 95 jobs being phased in over 2 years. The average worker makes about $50,000 a year. That's a total annual payroll of about $4.8 million at full operations. The capital investment is about $15 million. Now we have some other descriptions that we've added here, a description of the project. We've added some additional hiring details, and then ultimately we've included some recommendations. So this fact sheet is, like I say, kind of a really nice summary of what's going on with the project. Now, if you'll notice, if you think about this very carefully, we really haven't done any analysis. We're just repeating back the facts, so the basic facts of the project. So if we want to get into that analysis, that's kind of the main point of Impact Dashboard. If we click here on the summary report, we can see we've got a number of summary reports, one for each one of the jurisdictions, and then we have kind of an overall community report. And on these reports, we've got a one-page summary of the results of our analysis. So essentially, we're performing with Impact Dashboard, we're performing an impact analysis. And in terms of impact analysis, this is geared specifically to economic development. And so with an impact analysis for economic development, we want to hit on 3 key things. And so the first one is going to be the economic impact. So if this project with their 95 workers and their initial investment, what additional economic spin-off benefit will that generate in the community? And so when we say spin-off, we're talking about the indirect and the induced activity elsewhere in the community. And so here, if we look in these blue boxes now, we can see we've got a little bit of detail. This is where we start doing our analysis. So we've got 95 direct jobs, and based on this industry and based on the local multipliers, we're using RIMS2 multipliers from the Bureau of Economic Analysis to generate these results. And so we can see 95 direct jobs, that's going to generate an additional 70 spin-off jobs. So in total, we're talking about a little over 165 jobs to be created or associated with this project. Now, with respect to salaries, we're showing that the spin-off workers make a little bit less than the direct workers, but overall, the average across all 165 workers is about $46,000. And there's our capital investment of 15 million again. And then we have a box that says residential development. And what we're getting at there is when we create 165 jobs in the community, as this project might, there may be some population impacts to consider. And so here we're identifying about 7.1 household relocation, so kind of worker households relocating to the community. So you might have some population impact as a result of this. And then we make some assumptions to say some of those folks might build new residential property. And so we're looking at maybe one, and kind of weird numbers here, but 1.1 new homes. And that's all going to generate some additional revenues for us as we kind of get further down the line. And that's really our next piece here. So we take these economic impacts that we have in these blue boxes, and we translate them into the additional revenues and costs for the local governments. And in this case, we're looking at a summary specific to the city of Burleson. So right now, in this chart at the top, we can see our expected benefit over the next 10 years, these dark blue bars. If we were to add all of these up together and kind of stack them on top of each other, that would add up to about $1.5 million. Now, there's going to be some additional costs that we estimate in our model, thinking about the city's cost to provide services to these new households or to this new business itself. And so we've estimated those costs at about $730,000. And that's these lighter blue bars below the line. Now, ultimately, when we take those two pieces together, we can get our net benefit. And that orange line, each of these orange dots, kind of represents our net benefit each year. And so again, stacking up all those orange dots, we've got $830,000 of net benefit. Now, that's kind of one of the big key metrics we're going to be using in our analysis, is this idea of the net benefit. So the additional revenues minus the additional costs the government might have, and kind of what's the net benefit that this project will generate for, in this case, the city of Burleson. If I scroll down, we can see more detail on the specific revenues and costs here. We've got some sales taxes, property taxes of different types. You can see all the different things. And so the benefits that you'll see in your model are going to be specific to your community and the taxing structure and so forth. Again, we're looking at a Texas-based community. They're kind of taxing everything. You can see inventory, property taxes, and everything here. On the cost side, we're pulling out some costs, as I mentioned, to represent the types of services that the city would be providing that we want to offset here and thinking about this new economic activity. And so we can see those specifically listed out. We can see also that we already have an incentive kind of baked in here. This asterisk for real property taxes, this asterisk of, it's telling us that the above value excludes the property tax abatement of about $187,000. So right now it's showing us we're going to get about 100,000, but it could be more if we didn't do that abatement. What that's telling us is that if we've already pulled out the 187. So another way to say this would be if we didn't offer the property tax abatement, those real property taxes would go up. They'd increase by the amount of that abatement, so $187,000. That would have kind of that ripple effect to kind of have our benefits go up by 187,000 as well as our net benefits then. But we are kind of stacking incentives together here. So we've got a property tax abatement where we're pulling out some of those revenues. But then over here in this box, we have an additional incentive that we've modeled. So thinking back to an economic development impact analysis, we've got the economic impact. We translate that into the fiscal impact. And then we want to make sure we analyze the incentives that might offset or kind of serve as the return on some of these incentives or investments. And so we're modeling a $400,000 infrastructure grant in this project. So this is our total incentive of $400,000. And that can be thought of as an investment in the project. We think of that $400,000 investment, we compare that to the net benefits that the project generates over the term. In this case, we're running the analysis over 10 years. We can see that here. This is this 1 through 10. This is telling us we're doing it over 10 years. And so over 10 years, we're getting $830,000 in net benefits. So if we kind of take that cumulative net benefit over 10 years, that's going to be $830,000. So that's what we're seeing right there. The dashed line that we see down here is just the total incentive amount, which is $400,000. And so kind of looking at this, we can identify that the kind of break-even point, so to speak. So that point at which the city will collect enough in net benefits to cover the value of that initial incentive. And so it's somewhere between year 3 and 4. We can actually see we've calculated it's 3.7, and that's what that's telling us right there. So our payback period, again, identifies the point at which the project will generate enough net benefits to pay back the value of that incentive. We can also do some other simple math and just calculate an average annual rate of return. So in this case, the net benefits are about $830,000 over 10 years. So that is about $83,000 a year. On an initial investment of $400,000, that's about 20% average annual rate of return. We had 95 jobs being created here. So if we just do, again, some simple math, taking the $400,000 incentive divided by the 95 jobs, it's about $4,200 per job. So that's what we're capturing here on this one-page infographic report. And as I mentioned, we had that fact sheet. We weren't really doing a lot of analysis. And then here on the summary report, we're kind of trying to put into one page kind of a ton of analysis that we've done on this project. If I click down on our list, so this is just a one pager. If I click down here, we can get a report for Tarrant County. And so we could offer, so Tarrant County is going to have different revenues, right? Their portion of the property tax rate is going to be different. They don't collect sales taxes, they don't have city-owned utility, that sort of thing. And so we're seeing what specifically the county would receive. So while the city was getting $830,000, the county is going to get about $300,000 from the same project. Now, if I scroll down, we can see we've evaluated a $100,000 incentive here. Again, in this kind of made up scenario, we're thinking that the county might offer or might invest $100,000 in this project. And so if that were the case, we'd be able to calculate the rate of return against what on this $100,000 investment on what the county is going to receive in the $300,000 over 10 years. And we can, again, calculate their own payback period and rate of return. Now, we have individual reports for each one of these jurisdictions, so we can click through each one of those if we would like. We also have a community report. This is where we can kind of configure our own one-page report and include whichever jurisdictions we want on that report. So in my case, maybe I just want to have the city, the county, and the school and kind of get that 3 districts total. And again, we can see these numbers we've seen before, $830,000, $300,000 for the county, and so on. But ultimately, this is kind of giving us a snapshot of those 3 entities together on a one-pager. You can go up here to this configure button and actually add, for example, you could add the hospital, and you could also add the college, and get all of your districts here on one page and kind of get the overall view, and so kind of understand the total local impact. So the community report is really nice to kind of branch out and get some other jurisdictions all on one page, but sometimes you need a little bit more than just one page, and that's where we come in with the detailed report. So our third report that we have here after the fact sheet, after the summary reports, is this detailed report. And this is going to be a little bit more like a traditional report with a narrative and a number of tables that we step through. So the links that you see over here on the left side are actually kind of sections within the report. So we can jump down to different sections that we want to hit. And so, for example, we have an economic impact overview showing us some of those economic impact numbers that we've calculated. So the direct and spin-off jobs, some sense of the population impact that we kind of saw some of these numbers before with the 7.1 new households and so forth. And if I scroll down, we also have a table that shows us kind of what we're assuming about the property. So when we put in our capital investment, we're going to take that information and run it through some parameters and then spit out kind of this estimate of taxable property. And that's kind of where we're applying our property tax rates when we're getting those estimates. And so we can just, this is a nice table just to come and look and make sure everything's kind of looking right. Now, if I keep scrolling down, or if I jump down to our next section, we've got a fiscal impact overview, and this is kind of summarize across all jurisdictions at a very high level the benefits, the costs, and the net benefits for each one of these jurisdictions. And we've kind of seen some of these numbers before as we've been looking at things. I'll jump down again to our public support overview. This is where we're going to get a kind of a full picture of all of the incentives under consideration for this project. In this kind of made up project, I have a property tax incentive valued at $187,000. And then I've got 2 other incentives, $400,000 and $100,000. In total, $500,000, and we can see the total package. And so this might be the way you could think about presenting it to the company if you're trying to get that number. The total package that you've put together in this instance is $687,000. So the value of the all of the different incentives is about $687,000. If I keep scrolling down, we're again going to see some more information that we've kind of seen in other instances. This one for the city of Burleson, here's our fiscal impact, our benefits, our costs, and that $800,000, $830,000 of net benefit. The interesting thing, or the additional thing that we do here, is we actually break out the total. So far we've been focusing only on the total numbers here on this kind of right side, but we break it out now on this table to show what revenues and costs are kind of associated with the project itself, and what kind of revenues and costs are associated with those assumptions about new households. And so we can see kind of on the bottom line, as we add these up on the total net benefit, about $730,000 of it comes from the project itself, and only about $100,000, a little less than $100,000, comes from those new households. So that, at least to me, it looks like a good project, because most of the impact of those net benefits is a result of the project itself. If I keep scrolling here, we'll see different things showing us the net benefits. It also shows us some analysis of that property tax abatement. We'll talk more about all these different incentives in a moment. But as I scroll down, we can see now we get to the county, and you can see down on this left-hand side, we've got sections for each one of those jurisdictions. Ultimately, we have a methodology section as well, which will describe, kind of the approach here. And then finally, we have an appendix. Depending on the particular project, you'll have an appendix. This case just dealing out some of those year-by-year numbers for that property tax abatement. If I scroll back up to the top, one thing I did not mention was this print button at the top. And so, of course, it says print. It looks like we're going to actually print out a physical copy. That's not really what you would necessarily want to do. If you just want to generate a PDF, go ahead and hit that print button, and then choose your destination as Save as PDF. And so you'll see when you hit print, and we can choose our essentially our printer, so to speak, as the Save as PDF, we can download and save a nice clean copy of this project as a PDF. One of the things I'll point out as we're looking at this is all of my page breaks are kind of in a really good spot. We can see that as I click through, and that's going to be the case if you're using Google Chrome. So that's one of our kind of requirements here is we want our clients to use Google Chrome as their web browser as they're using Impact Dashboard, so that the printing and everything, or the saving as a PDF, I should say, works perfectly. Okay, so that's the kind of big idea with Impact Dashboard. We're trying to estimate these impacts in the context of economic development and allow you to evaluate incentives. Now, the way we're doing that, we're getting the information in here, and we're plugging in basic details about the project. So for instance, we're putting in a NAICS code, and that's going to incorporate those multipliers we talked about earlier. You're specifying the job creation over time. You're indicating how many or maybe what percent of the workers might be moving to the city as a result of this project. So that's kind of capturing, helping us get to that population impact idea. And so this percentage might change in a particular project. So if you're working with a company and they're relocating from, let's say, from across the country, and they're going to be bringing with them a lot of workers, you might think, well, actually, we think there's going to be a lot of these direct workers moving to our city as a result of this project. So let's increase that percentage. Maybe it's going to be 25%, maybe it's going to be 30%, whatever. In another instance, maybe based on the jobs and your local labor force, you feel confident that you're not going to have people moving to the city because of this specific project, and so you might just say, okay, well, let's zero that out. Let's not assume anyone's going to move here as a result of the project. And so you can kind of configure that based on what you know about the project at hand. Again, we've got salaries that we can enter in, and we can see some of these other inputs for like capital investment and so forth. So this scenario info page is kind of that main data input screen. We can also talk about kind of another component of Impact Dashboard, which is our data form. So if you have the information about a project, you would likely just come in here and start a new project from scratch and type the information in. But if you wanted to, you can also use Impact Dashboard to collect the information from a prospect. And so in that case, you could use our data form. So I'm going to close out of our scenario. We'll kind of take a look at a few other spots here. So this is our project control center for Vandelay Industries. You can see not only was I have this $400,000 infrastructure grant, that was the scenario we were just working on, but we have another scenario too. So we've got the ability to kind of do different iterations of the analysis. And so that's kind of built into the software. So if you need to kind of pick up where you left off on a previous scenario, you can hit copy. So over here, you can hit copy on the scenario and kind of, run another iteration. Now, what I wanted to show was this data form. And so this is, in our case, we have received a data form that our prospect completed. And so if I just click on this, we can actually take a look at what the submitted data form looks like. So the really great thing about our online data form is the fact that you're going to start off with a summary. So right at the top, we're just going to give you a bullet point list of the basic information the prospect provided in the data sheet. So we can see kind of in bold all of their responses. And we can just kind of review this briefly. We can see 85 jobs is what they initially submitted. And the workers are going to make 70,000. We can see all this information. We can see who the company is. We see all this, and we can even keep scrolling. And if we wanted to, we may not want to, but if we wanted to, we could scroll down through the entire data sheet just as the prospect filled it out. And we can see this is kind of read only at this point. I'm clicking on things and I can't actually edit them. And that's because it's kind of frozen in time. This is the information the prospect provided, so we're not going to let you modify it. We're just viewing the information that they submitted. And now the kind of the great benefit of using our data form, and it's all kind of integrated and it all stays electronically, is you can just hit create a scenario, and it'll take that information that your prospect submitted and then paste it into your model and let you start modeling it. And so as we looked at that, we saw that they had said there were 85 jobs to be created. What we can see here, though, in this scenario, we were modeling 95 jobs. And so that's that idea that they might submit the data form and then say, oh, wait, things are changing. It's not 85 jobs. It's actually going to be 95 jobs. We're going to, we've got some of the things that are changing. And so it's within these scenarios where you're modeling it you can go in and modify maybe the information that the prospect provided. So you're not stuck, it's not kind of frozen as what the prospect submitted. Um, and so we can see that's where I've changed some of these numbers. But originally it was started from a kind of a copy, so to speak, or a pasting in of that initial data form. Now, just to kind of give you a little bit more sense of where we are in the app, I'm going to go back kind of another step. We've been looking at a particular scenario. Then we stepped out and we're looking at this control center for our Vandelay Industries project, where we can see multiple scenarios. But if I step back one more layer, we're going to go to all of our projects, and we'll be able to kind of get to this active list of our projects. And so we can see Vandelay Industries is listed up here in the upper left. That's the one we were working on most recently. I've got many other projects here that we can see. And these are all on our active screen, so to speak. We can categorize these projects based on their outcome. So if we kind of have this one resolved and we get them in our community, we can move this to our category for won projects. But we've got a category for lost and archived as well. You can see, just looking at each of these tiles, they contain some information. They're showing us kind of the project type and then the key or broad industry type as well. And then we've got some other tags that we can apply. We can also see that this one has 2 scenarios that we mentioned. I'm going to go back in, and now we're going to just kind of talk more about incentives. And again, if you have questions or you want me to go into detail on a particular topic, feel free to type in either a question or something in the chat, and I should see it and we can address it. But let's pretend for the moment that we've plugged in everything. We've got all of our inputs correct. Maybe we're looking at some of the results and everything kind of looks like it's coming through right. But we want to just go through and modify the incentives. We've got a different scenario we're going to model. And let's start off with, let's get rid of the $400,000 infrastructure grant. So I'm going to go in to our public support. I'm going to remove that. And then we're going to look at maybe like a 380 agreement where we're going to rebate property taxes. So what I'm going to do is click here on public support. And for our example, I'm going to assume that the city is the one that's considering this 380 property tax rebate. So I'm going to click here within our public support area. I'm going to click on the city. And we're going to see all the different kind of incentive options or modeling possibilities that we have here. And I'm going to scroll all the way to the bottom, which is where we have that $400,000 infrastructure grant. And for right now, I'm going to remove that. So we're going to get rid of this $400,000 infrastructure grant. And now what we want to do is we want to model a rebate of property taxes on all types of property at 100% for 5 years. That may not be what you do, but just as an example, we're gonna walk through that. So first off, this first section that we have here is kind of related to the property taxes. And I can click on this drop down, and I can actually select our terminology. So if we're going to do like a 380 rebate in Texas, that's going to be a kind of more appropriate to call it a property tax rebate. So I can actually change that from abatement to a rebate. And just to kind of give us some understanding of what we're looking at here, these dark blue bars over here are showing us the property taxes that the city is expected to collect on the company's new property. So there was that capital investment, and that's going to be, representing some property on the tax rolls. And over the next 10 years, based on the city's portion of the property tax rate, we're expecting to get about $770,000. Now we've already got some abatement rebate stuff going on here, but let's change that up, and we'll kind of see how these rebated values will change as we're doing this, and ultimately change what our net collection is. So I'm going to change this, and we're going to say we want to do 100% rebate over 5 years on all types of property. And so I'm modifying my schedule here so that we're not doing things out beyond 5 years. And that's for the building. And with this little checkbox just tells us, yes, do that in abatement. So if you wanted to kind of toggle it off, you could uncheck that box and you'll see that, our rebate goes to 0. And that's because even though we have a schedule in here, we've just kind of unchecked that box. So let me check the box here for the building. I'm going to check the box for our FF&E as well. That's going to give us some additional rebate there. And let's also do the inventories. I'm going to put that down here. In my particular case, so now we see we've got these different elements of our abate or rebate in this case. We've got the 3 different colors that we can see. I didn't do anything on land. In this case, I think I know the fact that we don't have any land on the tax rolls that we're modeling here. We can double check that though. So let me show you how to do that. I'm going to click on the report and I'm going to click on our detailed report and I'm going to jump to our table that shows us the value of taxable property over the first 10 years. And we can see kind of based on the capital investment, some of the parameters we have about whether or not there will be real property appreciation. In our case, we put it to 0, and whether or not the FF&E will depreciate in value over time, which we have there. We can see that. So the land is 0 because we haven't put any in or we haven't accounted for any land, and that's fine. But that's why we saw that when we added this 100% on 5 years for land, nothing else happened. So this is good. We've got a lot going on here. We can see our total property taxes were expected to be 770,000. The rebate now is about 470,000. So on a net basis, the city is only going to get about $300,000 from those property taxes. Now I can click over here. So we've got a graph. This graph is kind of cool to see how it's happening over time. But if we want to see the raw numbers and not have to hover over things, we can get our raw numbers this way. So here's our $770,000 in total. So this is starts at about 100,000. You can see that. And then those rebates, we can see they happen over 5 years. That in those years, we don't have any net collections. We're only getting property taxes after year 5. And we can see those 300,000 there. So if I'm going to go, let's say that I'm going to do that. Let's jump over to our report. And we're going to see how things have kind of shifted around. Let's just go to our summary report. And you might not remember exactly what this looked like before we started doing all of these things. But we can see right now, we have our net benefit kind of depressed in these first couple of years, and then it jumps up in year 6. And that is all related to this property tax rebate that we've modeled. So now we can see our net benefits are shown as $548,000 instead of before they were like 830. And then the reason for that is because we've layered in this property tax rebate that is going to be pulling down the property tax revenue we were initially planning to get. And so in this case, now we're showing asterisks that kind of indicate we've got a lot of property taxes rebated, and that total value of the property tax rebate is now $470,000. We can see now in our little kind of incentive box over here on the right-hand side, we've got a little bit of an analysis there showing us some of those key numbers that we had before. We were expecting to get 770,000 in property taxes. We're going to rebate 470,000, so our net is 300,000 just specifically on property tax for on the company's property. So that, as we see here, that's affecting our net benefits. So it's pulling down our net benefits. We can do it. We talked about toggling those incentives on or off with that checkbox. Let's kind of do that. And let's just see if we weren't offering, let's say maybe you're going back and forth. Maybe you don't want to do this. Maybe you do want to do it. If we remove that rebate, so now the rebate goes to 0, we're going to get all of the taxes we thought we were going to get, all 770,000. Now we can see that our net benefits for this project, they've gone up. They're up to $1 million now. They've gone up by that amount of the rebate, right? That makes sense. So we were having some revenues come in, but we offer this rebate, so that reduces those revenues, and now our net benefit ultimately goes up. I'll stop here for a moment and talk about this idea that we're not treating this incentive, this rebate, as a cost necessarily. We're not thinking of it like money out of pocket. We're not thinking about it like an infrastructure grant. And so in that sense, again, because the company is kind of adding this property and then we're just going to rebate some of those taxes, since we're just going to reduce the revenue that comes in, we don't think of that as money out of pocket, and we're not calculating a rate of return and a payback period in this instance. We do have some communities, so that is kind of what we're looking at right now is kind of our default way of doing things. We do have some communities that want to calculate kind of a rate of return, so to speak, on a rebate or an abatement or kind of any kind of tax incentive where you're reducing that amount. And so we can, and I'm not going to do it right now, but in the model, we can flip things around so that we can calculate that. But like I say, kind of our default way and the way that the majority of our clients will look at this with a tax incentive, whether it be sales taxes or property taxes, as we're talking about here, we're just going to reduce the revenue coming in, and we don't think of that as, a real cost or money out of pocket. There are definitely kind of different philosophies on this. And so if your community may look at it a different way, we can accommodate that. But just as we're looking at here, we're kind of using the more typical way that our clients will look at it, which is those tax incentives will reduce the revenue. They won't be represented as a real cost out of pocket. Now, let's scroll down. We've got the ability to do different types of rebates, so or exemptions or whatever we want to call them. Again, we can change these terminologies based on what's actually happening. So for example, capital investment sales tax rebate. So this is on those initial purchases of construction materials and furniture, fixtures, and equipment. So we might be generally picking up a little bit of sales tax on those purchases, which we see here in our case is about $65,000. Our investment's only happening in year one, so that's why this graph kind of looks a little weird. But if we wanted to rebate some of those or exempt some of those or reimburse some of them, whatever the terminology may be, we could do that. If the project itself will have sales tax, taxable sales, so if it's, say it's like a retail development and you're going to offer like a rebate of some of those sales taxes that get generated on site, you could do that with our model kind of in the same way that we did with the property. Except here we're going to be focusing specifically on those taxable sales by the company. We're not going to, I won't model that right now, but just kind of looking at the other sales or the other types of tax rebates or exemptions. We could also do a hotel tax rebate. If you're just picking up a little bit of hotel tax from visitors, maybe you might not be rebating hotel tax on it. But if you are evaluating a brand new hotel in your community, you might be sharing back some of that hotel occupancy tax with the community, with the developer, for example, or the hotel. And so if you needed to be able to rebate hotel taxes, you could do that in our model as well. And in all instances, I should say, these tax rebates are just going to reduce the revenue coming in. Now we get to this last section, which is our kind of a generic term. It's a non-tax incentive, right? So everything else was related to taxes: sales tax, property tax, hotel tax. Now we have a non-tax incentive. And so it's a generic term, but specifically the idea is that you would use it for anything where it's kind of cash or near cash. So this is kind of those money out of pocket instances. So in our initial case, we were looking at an infrastructure grant, maybe $400,000. We can run that sort of thing. You could also think of a non-tax incentive. An example would be like a job creation grant where you're going to give them $2,000 per job. Other instances might be if you are maybe you have a piece of land that the city or the EDC owns, and you're going to give it to the company, to free land, so to speak. You give the company a piece of land, but you want to treat that as an investment or incentive in the project. And so if that land's valued at $200,000, you can think of $200,000 as this non-tax incentive, which is the value of that land. So let's just start real easy. Let's do a $400,000 infrastructure grant, kind of where we were earlier. I'm going to do that, and I'm going to put it kind of getting paid out in year one. So I'm going to put $400,000 in year one, and that's going to kind of model it over here on our right side. We've got this dark gray box that's showing us the 400,000. We've got the dashed line that shows us 400,000 over the full 10-year term. And then we have this orange line. Again, this orange line is showing our net benefit. It's our cumulative net benefit over 10 years. For, in this case, again, we're on the city's public support site. So this is over 10 years, the city was going to get $1 million. Now, remember, I'm going to jump around. Go to our report. This is the case where we're not doing any other abatements or rebates or anything. So it's just the city's going to be getting $1 million based on the benefits and costs of this project. So going back to our public support, going back down to our non-tax incentive, this orange line is the cumulative net benefit. So by year 10, it hits that $1 million number. Now, again, we'll kind of see the intersection point is where these two lines intersect. That's our payback point. So somewhere between year 2, but almost right before year 3. So we can see 2.8 years is our payback point. Again, at 2.8 years, just before 3 years, the city's going to collect at least $400,000 in net benefits. Again, our rate of return is calculated kind of simply, just taking $1 million over 10 years is about $100,000 a year. And so if I got $100,000 a year on an investment of $400,000, that's about a 25% average annual rate of return. the per job incentive still is the relative to the 95 direct jobs. So that is kind of our approach there with looking at incentive. Now you can, you could think of other instances. Some of our clients will pay that out maybe in multiple steps. Maybe it's 200,000 first and then $200,000 later, something like that. But whatever you select is going to get modeled, and we'll see those results come through here, specific to the city as we were looking at it. Now, maybe it's not going to be an infrastructure grant. Maybe it's going to be a job creation grant, and we're going to pay the incentive out based on their hiring schedule. And so maybe we're going to pay them, let's just do $5,000 per job as they're hired. And so if we wanted to model that, we can do that by clicking on this little drop down for incentive approach. And this is going to give us our options. We can actually do a number of different incentive options here. We can see incentive per job, rate of return, or payback period. It's those same metrics that we see across here. We can target any one of those and let the model calculate the rest of them. So if I want to do an incentive per job and I want to do $5,000 per job, I can plug that in, and we'll see now we have two gray boxes representing those kind of two investments. In year one, we're going to pay out $250,000, and then in year two, it's going to be $225,000. But in total, it's a total of $475,000 because we have the 95 jobs, if you remember. And then again, we can see where does that intersect, somewhere between year 3 and 4. And we can see right there, it's calculated at 3.6, a little bit lower average annual rate of return, just because we have a higher incentive amount on the same impact, that same 1 million of net benefit. We can also do, let's say target a particular payback period. So some of our clients will say, hey, we're going to do an incentive for this project. We like this project, but our rules dictate that we can't offer an incentive that has a payback period longer than 3 years, right? I'm just making that up. But let's say that they want to have that upper limit of a 3-year payback period. You can select your incentive approach as payback period and then specify 3 years. And now our model will calculate for us the incentive that could be paid to get us exactly at 3-year payback period. It's just over $400,000 in this case. Sometimes you'll have incentives that kind of combine, and so you're trying to get that all in one shot. And what you would do is just add them together. So let's say you're going to do a $400,000 infrastructure grant, and then in addition you were going to do a job grant after they get done all their hiring. We're going to pay it in year 3 after they make sure they do it, right? So $200,000 paid out in year 3. And so you could kind of combine multiple incentives into this stream and calculate that combined payback period and rate of return. As we've been talking about this, we have this overview section that's going to update for us. And so we've been working against the city of Burleson's net benefits. And so that's the 600,000 we see here. Tarrant County, we still have that $100,000 incentive, and we could jump on in the public support area for Tarrant County. We can model incentives for them. So we could do kind of an independent property tax abatement. So let's say the city's doing a 380 rebate, the county's going to do a property tax abatement. Maybe they're doing different percentages or schedules. You can kind of jump back and forth and do that here. If I scroll down, this is where we have that $100,000. So maybe we want to play around with the idea of maybe giving them $200,000 and plug that in and see what that looks like. And again, as we do this, everything's going to update as we go along. We can jump back over, and again, one of the cool things, we can get that full package summarized here in the report for us to kind of give us the full value of those incentives that are being considered. I haven't seen any questions come in yet or anything in the chat. So please do, if there's something that I'm kind of skipping over or you want to see, we can certainly add. We can talk about that. Let me jump back here, and what we can do, let me put in, let's talk about stacking these incentives on top of each other. So for example, we want to do a $400,000 infrastructure grant, but we also want to do that 380 rebate, right? So we want to give them the 100% at 5 years for 5 years on all their property. We also want to give them $400,000 grant up front. So how do we kind of put those two things together? Well, let me go back first. I'm going to put in just that 400,000. So we've got this. So again, 400,000, looking at these net benefits without any rebates or anything, it's $1 million, 2.8-year payback. But let's go up here and, like I say, stack these incentives on top of each other. So let's kind of check this box. So this is kind of turning these incentives back on. We can see as I do this, it adds the rebate. It's getting added together there. You can see it graphically as well. And now that has the effect of lowering our net benefits. So we thought it was going to be $1 million of net benefits, but now we're saying, hey, wait a minute, we're going to do this rebate, $470,000. So now our net benefits are going to be lower. And now we can see this orange line. If we stretch out all the way to year 10, it's about $548,000 of net benefits. Now, we can also see this line got really weird. We've got a big kink at year 5, a big kink in this orange line. And what's going on there is our net benefits are kind of reduced in those first 5 years because we have that property tax rebate being modeled. And then for the remainder of the period, our net benefits are much, much higher. So we see that line being a little bit more steep for those last 5 years. But what this has the effect of doing, as we can see already, is it extends our payback period. So now that $400,000 infrastructure grant will take us nearly 8 years to pay back if we've also offered them some of the property taxes that we were expecting to pay back that incentive, right? So I'm going to go to my report and we'll just kind of see some of these things together. Summary report for the city. We can see that line with the big kink in it. We're stretching up to $548,000. That's our net benefit that we're now calculating. This is where we've reduced our benefits that are coming in, again, because we've got this $470,000 rebate we've calculated. And then when we combine that with the $400,000 infrastructure grant, we can see our net benefits get affected by that as well. So you're going to be taking into account those property tax rebates kind of when you stack these things on top of each other, and you see that come together here where our payback period stretched. I think it was originally like 2.8 if it was only the $400,000, but then it goes out to almost 8 years when we add that rebate on top of it. And again, trying to summarize this, if you're looking at that for the the company, now our total incentive package that we've modeled is over $1 million in this case. So I think some of the best approaches to this, and I think you might already be kind of thinking it or seeing it. Each project is going to be kind of translated, so to speak, into this common language or common metric of net benefits. The net benefits for each project will represent kind of that value that this project will generate for the community. And so when we have those net benefits, when we have that stream of benefits, we can compare any incentive amount to those net benefits, and we're kind of putting all of our projects on the same footing, right? So, you might do if you think of this in terms of payback period, again, like this example of a community that has to hit a 3-year payback period. If every project is subject to a 3-year payback period, you're kind of being consistent based on the net benefits that project generates. We will give an incentive equal to, basically 3 years worth of the net benefits. And so that's an approach to kind of make sure you're being consistent with how you apply these incentives. And so by essentially taking the details about the project, translating them into these net benefits, and then comparing that to your incentive. Because as you can imagine, this is a manufacturing project, so it generates a certain amount of net benefit. If we look at other examples of projects, we can look at my other one, Project DM. This is technically it's an expansion project. So you have the company is expanding they have a kind of a business support services, and then they're going to add this paper mill. And so based on what they're doing, we can calculate, maybe an appropriate incentive against the net benefits that this project generates. So it really helps you kind of put everything on a level playing field and, evaluate things consistently in your community. Still not seeing any questions. So I think I'm going to wrap it up here. We have more information on our website, impactdatasource.com, if you want to go check it out. My name again is Paul Shurin with Impact Data Source. You can contact me just at paul@impactdatasource.com. Feel free to reach out if you have questions, or if you want to, get maybe a one-on-one demo. We'd love to chat with you. Thanks so much for taking the time today. Enjoy the rest of the day.